Fixed income securities play a critical role in diversified investment portfolios by providing income generation, capital preservation, risk management, and liability matching capabilities. Unlike equities, which primarily derive value from capital appreciation, fixed income investments offer contractual cash flows through coupon payments and principal repayment. These predictable cash flows make bonds particularly attractive for investors with defined spending requirements or future liabilities. Institutional investors such as pension funds, insurance companies, and endowments often rely on fixed income allocations to support liability-driven investment objectives. Fixed income securities also tend to exhibit lower volatility than equities, helping stabilize portfolio returns during periods of economic uncertainty. Consequently, fixed income remains a foundational component of strategic asset allocation frameworks across investor types. Fixed income mandates can be classified according to their objectives and investment approaches. Broadly, mandates may focus on total return, income generation, capital preservation, liability matching, or risk management. Total return strategies seek to maximize risk-adjusted returns through active management of duration, sector allocation, and security selection. Income-oriented mandates emphasize stable cash generation, while capital preservation strategies prioritize minimizing losses and maintaining principal value. Liability-driven mandates align asset cash flows with future obligations, making them common among pension plans and insurance companies. Each mandate influences portfolio construction, benchmark selection, risk tolerance, and performance evaluation. Understanding the specific objective of a fixed income mandate is essential because investment decisions should consistently support the intended portfolio outcomes. The risk and return characteristics of fixed income securities differ significantly from those of other asset classes. Expected return is derived primarily from coupon income, reinvestment income, and capital gains or losses resulting from changes in interest rates and credit spreads. Risk measures commonly include duration, convexity, spread duration, yield volatility, and credit risk metrics. Duration estimates a bond's sensitivity to changes in interest rates, while convexity captures the curvature of the price-yield relationship. Fixed income securities also exhibit varying correlations with equities and other asset classes depending on market conditions. High-quality government bonds frequently serve as defensive assets because they often perform well during periods of economic stress and declining risk appetite. Liquidity is another important consideration in fixed income portfolio management. Bond market liquidity varies significantly across issuers, sectors, maturities, and market environments. Government securities generally offer the highest liquidity because of active trading and broad investor participation. Corporate bonds, structured products, and lower-rated securities may experience wider bid-ask spreads and reduced market depth, particularly during periods of market stress. Liquidity affects transaction costs, portfolio flexibility, and the ability of managers to implement investment strategies efficiently. Investors with significant liquidity requirements may favor highly liquid securities, whereas investors with longer horizons may accept lower liquidity in exchange for potentially higher yields. Effective liquidity management is therefore a critical component of successful fixed income investing. Modeling fixed income returns requires understanding the primary drivers of bond performance. A commonly used framework decomposes expected return into several components, including income return, roll-down return, changes in benchmark interest rates, changes in credit spreads, and the effects of currency movements when investing internationally. Income return reflects coupon payments earned over the holding period. Roll-down return occurs when a bond moves down the yield curve as it approaches maturity, potentially increasing its price if the yield curve remains unchanged. Interest rate movements and spread changes can generate capital gains or losses. This decomposition framework enables portfolio managers to identify sources of performance and evaluate investment decisions more effectively. Interest rate risk is one of the most significant determinants of fixed income performance. When market interest rates rise, bond prices generally fall because existing bonds become less attractive relative to newly issued securities offering higher yields. Conversely, declining interest rates typically increase bond prices. Duration provides an estimate of the magnitude of price changes resulting from interest rate movements and serves as a primary tool for risk management. Longer duration bonds exhibit greater price sensitivity and therefore greater potential volatility. Portfolio managers actively adjust duration exposure based on interest rate expectations, liability requirements, and risk constraints. Effective duration management allows investors to balance return opportunities against the risks associated with changing monetary policy and economic conditions. Credit spread movements also contribute meaningfully to fixed income returns. Credit spreads represent the additional yield investors demand for bearing credit risk relative to comparable government securities. Narrowing spreads generally result in price appreciation because investors become more willing to accept lower compensation for credit risk. Widening spreads have the opposite effect, reducing bond prices and increasing required yields. Spread changes are influenced by economic growth, corporate profitability, default expectations, and investor risk sentiment. Active fixed income managers often seek opportunities by adjusting sector allocations or selecting securities they believe are mispriced relative to their underlying credit fundamentals. Credit analysis, therefore, remains a core component of return generation and risk assessment. A comprehensive fixed income return model provides investors with a structured framework for understanding portfolio performance and making informed investment decisions. By separating returns into income, reinvestment, roll-down, interest rate, spread, and currency components, managers can better identify the factors driving results and evaluate future opportunities. This analytical approach supports portfolio construction, performance attribution, risk management, and strategic decision-making. Combined with an understanding of fixed income's broader role within diversified portfolios, return modeling helps investors align bond allocations with specific investment objectives and constraints. For CFA candidates, mastering the interaction between fixed income roles and return drivers is essential for evaluating portfolio strategies and developing effective investment solutions in both institutional and individual settings.